who's a trader, who's a trader on a real account, who is a trader on live real money. Because why is that? Well, person who trades on a demo only can of course teach about even advanced trading concepts, but not about real trading, because trading in 80% is just money management, trading psychology, and risk control. Sorry, and those three factors, they do not work when you trade on a demo account. Um, on a demo account, you can only find out how the platform works, maybe test your strategy, but real trading is done only on the real account, because psychological factors are 80% of the success. So I'm teaching on my live account on real money. I was doing various hundreds of webinars on with live trading, where I traded live, shared my positions, etc. And in my trading, I mostly focus on price action. I'm a swing trader, and this approach I try to show in trading. And of course, I have a strong focus on trading psychology. Sorry. So first, a few words about technical analysis. So basically, a technical analyst is a person who is looking at the charts, and the chart is basically price change over time, and based on this, technical analysis is trying to estimate the future direction of the price. We have a few foundations of the technical analysis. First one is that, in general, how it works is that price movements, trading decisions are based on the trading psychology. So basically, traders buy and sell based on the same factors as they did 100 years ago, 50 years ago, 2 years ago, and 2 weeks ago, because it's all based on psychology, and this never change. Even with the access to computers, software, etc., we still do trade based on emotions and trading psychology, and we make decision based on that. And traders making a decision is buying and selling. Buying and selling changes the price, so price changes are affected by our decisions, our sentiment, our psychology. And as this never change, you can assume that price is creating patterns, various patterns, which are similar to each other and result in a similar outcome. And this is one of the foundations of the trading based on technical analysis, that when you see a pattern formation on the chart, it's not the first time that this formation is created on the chart, because we have thousands of instruments, a few time frames. So on this pattern was already created somewhere, sometime. And let's say out of 1,000 times, it resulted 600 times with an upswing, for example, and 400 times with a downswing. What does it mean? It means that when you can spot this pattern again, you can see that it can give you higher odds of the upswing, and this itself can be an edge. You can get an edge over the market. You can gain an edge over the market thanks to this, that this formation more time is bullish than bearish. So based on this alone, you can trade. Of course, the better, the more things like that you have in your system, it increases the probability of success, because trading is just a game of probabilities. It's not a game of possibilities. Everything is possible, but you should go for things which are more probable. And as formations, patterns, price movements repeat over time. You have to learn them. You have to learn what does it mean that this formation is present, trade them and use them. Another foundation is that price follows trends. So basically, you have an uptrend when the price is making higher highs and higher lows. Prices going higher. You have downtrend, which is price making lower lows and lower highs, and sideways trends where pretty much price is moving sideways without any particular trend, which is a trend itself. And the thing is that price follows trends longer than you think. So going with the trend is always better in trading. Is always better. It's more probable. And again, trading is a game of probabilities. It's more probable that the price will continue moving in a trend than reverse. And just by knowing this, also it can give you an edge over the market. You have various tools in the technical analysis. You can just look at the chart, which is price action. I do price action, but you can use hundreds of indicators. You can use one out of hundreds of indicators. You can use them all. It all depends. But again, the most common factor, it doesn't matter if you use 5 indicators, one or none. Again, the most important thing will be money management, risk control, and trading psychology. About indicators, well, these are tools which are used to simplify price data and indicate potential trading opportunities. You have moving averages, which, for example, are used to show you the trend, if the trend is changing, if there is a trend. There are lagging indicators, so they are late. If you're gonna gain experience, you will not need moving average to tell you what the trend is, because you will be able to see this yourself. You have, again, hundreds, if not thousands of indicators. MACD, RSI are among two most popular ones, and they are basically used for divergences, but not all. RSI is used to see the overbought or over sold state of the asset. Charts can be presented as lines, which is pretty common because everybody knows line charts. They teach that at school, and also, for example, CNBC, Bloomberg, the biggest financial media outlets in the world, they are showing line charts because everybody knows how to read them. But you have also candlestick charts and bar charts. Candlestick charts are probably the most popular among retail traders, price action traders. They're amazing. They give additional edge over the market, so you can combine this with trends and formations and patterns. You can combine candlestick formations and patterns to give you an additional edge and to give you additional, let's say, certainty. But of course, in trading, nothing is certain. You never can be certain about any outcome. I will show you this when those charts when we will move to the platform. Fundamental analysis. Also, you can trade based on this, so you don't have to trade only based on the chart, on the price movements over time, but you can trade based on the fundamental analysis. So basically, all the macro data which is connected, which is surrounding your asset, the country of the currency that you trade, etc. Depending from the type of the asset or its commodity or currency pair, which currency pair is it, euro, dollar, or stocks. In this data you have to focus, but regardless of your trading, American data is key. Not all, of course. If you trade Polish stocks, you don't really have to know the new home sales in the US. But non-farm payrolls, yes, you have to know. You have to know inflation, and you have to know interest rates. of American dollar. Non-farm payrolls, by the way, is the change in the job force. So it shows us when there's a lot new jobs being created. It's great for the economy. When there is a drop, which we last time saw during COVID, millions of jobs were cancelled, dropped, and it of course affected stocks enormously. As I said, non-farm payrolls, interest rate. Why interest rate? Because interest rate is key for the currency, right? Currency, everything has its price, but also currency have their own price. Sorry, we can say this is interest rate. So the higher interest rate means that generally, let's say like this, when a central bank increases interest rate, it usually increases the demand for the currency. When central bank lowers interest rate, it should decrease the value of the currency. Should not, it does not always work like this. For example, in Turkish lira, several months ago, it was a very popular topic. Bank of Turkey was increasing rates because Turkey was losing value like crazy. Inflation was skyrocketing in Turkey. Turkish lira was losing value. Central bank was increasing rates. It was temporary, good for lira. Lira was gaining, but then it was giving back all those gains. Most recently, we got interest rate decision from Switzerland. It was a cut, unexpected cut, and the Swiss franc lost a bit of value, and it was gaining for the past few weeks. But after this decision, lost significantly. When we're talking about macro data, one key thing: markets are always expecting a certain number, a certain data, right? So in the calendar, it is said that we're gonna have, let's say, GDP number from the UK, and sometime before this data is published, we know experts and analysts are surveyed about the forthcoming data. What do they think the data will be? Some say 2%, some 2.5, 3, etc. Out of all those answers, they get the consensus, and this is a number which is expected by the market. But when the number comes in line with consensus, there is no big reaction because everybody was expecting that. But when there is a huge miss or beat, the number comes higher or lower significantly, there is usually a huge movement on the instrument connected to this data. So if we talk about GDP from the UK, let's say it's British pound to Swiss franc, not American dollar, but Swiss franc. Let's say American dollar, of course, as well. So there is a huge movement there because traders need to adjust their view, their portfolio, their position to new number. And trading based on the fundamentals is basically trading on expectations. So we are expecting a certain outcome, we get something else or this, and something else it can be much better or much worse, of course. Trading psychology, as we said, by far the most important factor. You may not believe me, but that's truth, and you will find out yourself. I don't have to really convince you. It's not my job to convince you that trading psychology is the most important factor. I know this, that's the fact, that's how it is, and sooner or later, well, better sooner than later, sooner you will realize this, it's better for you. And sooner you start working on trading psychology, the better for your portfolio. Trading is really easy, but it's not simple. Let's say trading is simple, it's not easy like this. It's simple, you buy when it's going lower, to sell higher, you sell on the top, you gain money, of course. Simple. But to do this profitably, month over month, quarter over quarter, it is challenging. It really takes a lot of commitment, discipline. Mostly this commitment and discipline. For traders who do not work on the trading psychology, it also takes a lot of emotions, health. But once you work on your mind, on your psychology, emotions will not play a part in trading, and this should be your aim. You should trade flawlessly, without emotions, without mood swings. That's the aim. When you will accomplish it, this is when you will become a professional trader, and you will see that if it will be your main focus, trading without emotions, trading being disciplined, and you will stop worrying about profits. They will come. They will come eventually, but you need to give yourself time to practice, to gain experience, and to be on this market to learn. There are many, many traps from the psychological point of view. I just mentioned a few of them. Over trading. I still fight with over trading, although I do my best to trade as little as possible because there is limited amount of good tier one A plus trading opportunities, and also you don't want to spend whole day in front of the computer. Really, trading is about quality, not quantity. You can open 100 trades and still earn only 1%, and you can open one trade a month and earn 2%. Simple as that. More trades does not mean better, not in trading. So try to be like a sniper and pull the trigger only when the setup is tier one A plus. Emotions, fear and greed. Greed is good for Wall Street. It is not. But let's say that controlled greed in the meaning that you just want to make money and more money. Fair enough. It's okay. If it's not closing your view, if it's not shadowing your view, let's say, clouding your view, then it's fine. But when it starts to be a problem and starts to affect your trading decisions, in the meaning that you are not following your system, then it can become a problem. Fear is a huge problem. And when you're trading, you can fear basically two things. Or you can feel fear because of two things. And I will tell you which things and how to simply fix it. So when you open a position and you feel fear, it can be basically because of one, either the position is too big and those price swings are killing you because suddenly you see that you're losing 5% of your account or 10% of your account on a small swing. Or the second one is that you're just afraid that you open some rubbish trade without any real consideration. Easy fixes for this. First one, if you're afraid because position is too big, simply trade smaller. You should trade only with 1% or 2% of your capital, so potential loss should be 1 or 2%. Fix. Second one is that you're afraid. You start to feel afraid because you open some rubbish trade. It's basically over trading. So basically, you need to open only top tier one setups. And that's basically the job of the discipline for you to stick to your trading system, trading setup, and not just open trades out of the boredom, for example. Right? Trading psychology is basically 80% discipline, discipline, expectations, emotions, in the meaning that properly disciplined trader with a proper trader's mindset does not feel any emotions whatsoever. You can take profits without a smile. You can take losses without any doubts and tears. And it takes really work. It takes a lot of work every single day, even after years of practice. Again, you have various trading strategies. Basically, you can trade based on everything. Moon phases, I don't know, MACD, price action, trends, fundamentals, you name it. Still, the most important factor and common thing for all profitable traders is money management and risk control. Leverage. Let me explain leverage a little bit because forex market is it is said that forex market is volatile. Many people say that the volatility can kill you on the forex market. It is not true. Forex market is not volatile. Daily changes on the forex market of major currencies can be 0.2%, 0.4%. On the exotic instruments, it can be slightly bigger, let's say 1%. So 0.5% daily change of the price of the asset is a lot? Totally not. Stocks can move 4% a day without any news whatsoever, just like this. The thing is that forex market is not volatile. It is said it's volatile because of the leverage. So if you have $1,000 and you would want to earn money based on those small price swings, 0.2% a day, whole day, then it would be extremely boring, and you would need several years in order to make something, to make decent money with such a small capital. That's why leverage was introduced. With leverage, instead of you have $1,000, but with leverage 1 to 100, you control $100,000. And thanks to this, you can benefit on those small price moves. You can benefit on the small volatility. But remember, bigger profits is one side of the coin. There's second side of the coin, which are bigger losses. That can also occur. Building a trading plan, my friends, basically you can trade based on the fundamentals, technicals, whatever you name it. The thing is that you need your trading plan and you need to stick to this plan. Your trading strategy can develop trading on a demo account, no doubts about that. But learning how to trade properly, how to apply this strategy in real life, should be done on a real account. I'm not telling you to put all your life savings on a real account and trade. No. Even you can start with $1,000, a small account, and with this, learn. I'm sorry, excuse me. And with this, you will learn and you will see how it works, and you will be able to see how your strategy works in those conditions. We have our Telegram channel where I do share signals, trading signals from the setups I see. I recommend you to see it and join this Telegram channel. And of course, questions. If there are questions, you can raise your questions on the chat. But let's do a little bit of sightseeing, let's say, on the platform. I will show you a few instruments and a few. We will make an analysis. As you can see, and you will see how it works real time. I have a position on American dollar to Swiss franc, which is a long position. Basically, as you can see, this is when there was an interest rate decision from Switzerland. Before this, Swiss franc was getting stronger. And after this decision, we got a reversal to the upside. Swiss franc weakened. So it's fundamental. But also look, we had this support 38.2, but we had also this support, yellow one, just below 38.2 Fibonacci. And the price came back above, which means that this area, which was highlighted and is highlighted again with the orange color, that is a false breakout. False breakouts usually lead to the movement in the opposite direction. In this case, it's an upswing. So that's my position here, open here, stop losses here. It's already a nice profit. Let's see if this will continue. In addition to this, it can be a long-term position because it's in line with carry trading, which means opening, buying an instrument with higher interest rate. So I get positive swaps. So overnight, every single day, I will have additional amount of money being deposited to my account just by the fact that I bought American dollar with Swiss francs. So basically, this trade is based on the false breakout. False breakout means that all those traders, everybody was thinking that the price will go lower, short, short. And when you break a support and then you sell, stop loss should be above this support, then a resistance. So they got all created, they got all triggered. People see that there was a false breakout, so nobody wants to enter the short position now, and we should continue to go higher. Also, in addition to this, you can see that the trend in general this year, from the very beginning of the year till the May, was bullish. Apart from this, left shoulder head and the right shoulder, maybe if we're gonna have a bullish week, most probably we're gonna have a bullish week this week. I'm looking forward to start a new bullish wave here and maybe possibly a breakout of the neckline there. I'll wait. I'm gonna be patient because of the positive swaps, as we said. Another example, FTSE. So London index, we have an upswing here, then a correction, which is a wedge pattern. Wedge in the uptrend, wedge is a correction, and it promotes trend continuation. That's what happened here. We got a breakout to the upside, price went significantly higher. Today we are testing the broken resistance as a support. Test is so far positive for the buyers because the price stays above. Let's see, the base scenario is this price bouncing of this support should give us a signal to buy. Australian dollar to American dollar, that's my setup for the next few weeks, I would say, because since middle of May, the price is stuck inside of the sideways trend. By the way, that's a false breakout, and look what happened after the false breakout. Price is stuck inside of the sideways trend. I'm looking forward for the breakout, and once the breakout will occur, once the breakout will happen, I will open a trade, either short or long. I have a position also American dollar to Japanese yen. That's an ascending triangle. So ascending triangle is a horizontal resistance and a dynamic support. It promotes breakout to the upside, which happened. Once it happened, I will open a long position. Price went significantly higher and is now heading higher, close to the local highs. I look forward for a further rise. Actually, I could move my stop loss to a break-even point like this, and I did this. What it creates a situation where I cannot longer lose on this position. When the price will reverse, this stop loss order will be triggered on zero, and I will not lose money on this trade. So basically, my friends, I showed you two of my trades. I showed you how the platform works a little bit, and we talked about the technical analysis, fundamental analysis, money management, risk control, trading psychology. I hope you enjoyed this. Hopefully, we will create new, more webinars soon that you will be able to access them and learn more about the market. For now, thanks very much for attending this webinar, and hopefully see you next week. And good luck in your trading. Bye.